Hello everyone, I'm Anushree. Few days back, we were given a dataset using which we had to create a framework for issuing loans. PayWallet is an established digital payments company which has been operating in India since the past 5 years. In order to experiment with its new microfinance model, it is planning to issue a loan totaling of rupees 1 lakh to its prospective customers. We were asked to create a framework to provide the distribution of this loan amount among the customers. A loan disbursement method has to be found out using the default credit data that we were provided. From the data, we can see a number of factors on which the loan given to a person can vary. Like, this data provides us with a variable default, which indicates the people who have failed to repay the debt on time or have failed to meet the conditions of the loan. We can also see that a person who hasn't paid the previous loans on time have a less probability of getting a new loan. His employment condition is also an important factor, as a person who is employed will have a better chance to return the money on time than someone who is unemployed. Also, marital status and number of people under the maintenance, these are correlated. An unmarried person can pay the amount of loan faster since he has less people to look after, which in turn increases his savings and hence he or she can pay the amount faster. Larger duration of the loan shows that the amount of the loan payment is also large, and property may also be a factor to indicate the loan paying capability. We can see that there are a number of things from this data. First, we can exclude all of them who have default value of 1, that is, they are the ones who don't meet the required conditions for taking a loan. We can see that a large number of unmarried males have paid back the loans in time and also have low DM, that is direct memo. They also have lower installments as income percentages. Also, the average age of the people who take loans is almost about 35 to 36, and almost all of them are employed and have paid the credits duly on time. So, it is safe to provide them a loan. Most of the people who require loan are seen to be of the age group 20 to 40. We can see that most number of loans have been taken for domestic appliances and the least have been taken for the payment of cars that they have previously bought. Also, people who have been employed for more than a year and less than 4 years, and people who have been employed for more than 7 years or more tend to take loans more than the others and have paid the debts on time too. In the data provided about the prospective customers, 72.5% of them are skilled employee or officials, and most of them have either paid back the credits or have no existing credits in the given bank. Also, credit amount is an important factor here. It is the amount that the person owes to the lender. Therefore, we can say that the lower the credit amount, better is the chance for the person to get a loan, since it indicates that the previous loans were cleared on time. Credit history comes in the picture too. If the customer has paid his previous credit on time, it increases his probability to get a loan, as we have already discussed earlier. There are also cases when there is delay in paying the amount. For them, it becomes difficult to get a loan. A credit score can be assigned to them, which will help in distributing the loan amounts. It is actually a cumulative number that grades a person as a credit-worthy individual. Lenders typically assign interest rates based on what range the scores falls into. But credit scores aren't just used by banks. They are used by insurance firms, landlords, and even employers use credit scores as a proxy for figuring out how responsible a person is. The most widely used score ranges from 300 to 850. The higher, the better. In general, anything over 740 is considered to be excellent and will qualify for the best rates. And anything below 650 gives very high rates on loans, and credit cards are very high interest rates of credit cards are assigned. Credit score is generated based on the information of the credit report. The weights are given to the various criteria they look at, that is 35% of the payment history, 30% of the amount owed, that is the credit amount, 15% of the length of the history, that is the duration of the loan, 10% of the new credit, and 10% of the types of credits used. From all this, we can say that a loan can be granted to a person who has a record of clearing previous debts at time, has a job for a long period of time. Also, we can say that is a resident of that particular place for a long time. Since credit score is an important factor for loan distribution, it is a very important thing that needs to be checked. All these factors have been seen to be fruitful for the default data and may be useful for the prospective users too. Marital status and number of people under maintenance need to be looked into too. For new customers, their previous history of loans can be checked to provide better insight regarding their payment of the loans on time. and we can also check the credit scores. That's all from my side. Thank you.